The best of Money Matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. As global biotech investment landscapes shift, Asia-Pacific markets are rapidly emerging as key destinations for innovation. U.S. research funding cuts and ongoing geopolitical tensions are prompting investors to look beyond traditional hubs, seeking markets that offer political stability, strong intellectual property protection, and regulatory alignment. While China continues to dominate venture capital flows, emerging hubs such as Singapore and South Korea are gaining attention for their robust public-private support, world-class infrastructure, and talent-friendly policies. So what makes Asia-Pacific biotech markets particularly attractive for investors right now beyond cost and scale advantages? How are emerging hubs like Singapore and South Korea reshaping global innovation strategies in biotech? Well, to find out more, joining me now is Fabio La Mola, who is the partner at Bain Company. Fabio, welcome to the show.
Thank you, Hongbin. Thank you for having me.
Thank you so much for joining us. Well, Fabio, global investors are reassessing their biotech portfolios amid U.S. research funding cuts and geopolitical tensions, prompting a shift toward, Asia-Pacific markets. So why are APAC markets, particularly Singapore and South Korea, becoming increasingly attractive for global biotech investors?
Well, I think there is a couple of things that are playing in favor of Singapore and South Korea. As you mentioned, there is global instability, and especially in the US with funding research cuts that have been happening. Singapore and South Korea remain two of the countries that are still funding biotech from a government perspective. If you look at biotech, one of the key starters is actually government funding public research and funding basic research. Once it's done, then after that, ideas for new pharmaceuticals emerge. And Singapore and South Korea are still funding that basic research very, very strongly. In addition to that, South Korea is a fund that actually will match dollar by dollar any investment that private venture capital will make into biotech, therefore effectively de-risking the investment for venture capital. And given the fact that returns on R&D for biotech have been declining for a few years, this actually allows private capital to flow into biotech.
Then how are investors balancing the dominance of China with the rising appeal of smaller, politically neutral biotech hubs?
The advantage of smaller, politically neutral biotech hubs is exactly that, is the fact that actually being politically neutral, they can host biotech, they can host IP rights for biotechs, given especially South Korea and Singapore have very strong IP protection. And they can serve as a bridge between the innovation that is happening in China, where actually there is the second largest amount of world first-in-class new medicines coming up and being studied, versus the possibility that, in China you have a slightly lower IP protection that you would have in hubs like Singapore and South Korea.
Okay. Early stage funding in APAC has declined while late stage deal volumes have grown, kind of reflecting investor risk aversion here. How does the shift in funding patterns influence investor strategies in the region, you think?
So I think that the shifting pattern is a reflection more of the fact that there is more appetite for larger and de-risked deals than anything else at this point. If you look at the global pipeline for pharma, what is happening is a lot of the pharma companies are losing big products in terms of revenues over the next 5 years. So they're losing patent, and therefore they need to find de-risked assets that they can include in their pipeline and then start selling within the next 5 years. And this is what China and other smaller biotechs are providing right now, which is assets that are ready for phase 2, for phase 3 clinical trials, and therefore ready to sell in about 3 to 5 years.
Governments in APAC, they are actively bridging funding gaps for early-stage biotech R&D through programs like South Korea's KDDF and Japan's BioVenture Support Program. So, Fabio, how do these public sector initiatives enhance investor confidence and attract private capital?
If you look at biotech investing, typically the first stage is actually finding the right targets to target with a drug. And what is happening in public funding is effectively they are helping funding their initial part of the investment, which would be too much for private capital to fund. Once that initial investment is done, then private capital can come in and take a drug to market. So the fact that South Korea, Japan, and to a certain extent Singapore have support for that basic research allows private capital to come in when the asset is already de-risked.
Okay, I mean, emerging biohubs outside China offer growth potential, but also carry unique regulatory and market risks here. So, Fabio, what are the key risks investors should then consider when venturing into these markets?
So I think actually the first risk that any investor should consider when looking at biotech is the scientific risk that any new asset will carry. Biotech is inherently global, meaning if you develop an asset, if you develop a drug, that drug needs to be sold globally to actually recoup the investment that is being made in that asset. From a regulatory perspective, every market is unique and therefore every market is different in terms of accepting that new drug. And that's really what investors should be looking out for is number one, the scientific risk. Number two, the regulatory risk in getting that asset into the markets where it needs to be in order to be sold. Third is, of course, IP protection, because most of these assets will require the ability to sell undisturbed for about 15 to 20 years, depending on how long the patent is. And so having strong IP rights to begin with and having protection to those IP rights is quite important.
Well, speaking of risks here, geopolitical tensions and policy uncertainties, they're reshaping the global biotech landscape. So how are investors then mitigating risks and applying strategies such as geographic diversification and IP splitting in APAC?
So part of that risk is being mitigated effectively by building what is called the new co into certain geography. In these geographies, what is happening is investors are placing the IP rights, say, for example, from a China drug into a Singapore company for the rest of the world IP rights, which allows that new co to sell the drug across the globe from Singapore, protecting the IP rights directly in Singapore. And this is allowing investors to diversify the risk of the China rights versus the Singapore rights and the rest of the world rights, which allows, again, them to protect themselves in case there is issues with the IP being disputed within either China or outside of China.
Well, zooming into Singapore as well, I mean, Singapore has developed a world-class biotech ecosystem with strong government support, deep talent pipelines, and strategic partnerships with global players. So how do programs like, Startup SG Equity and collaborations with firms like Flagship Pioneering position Singapore as a launchpad for biotech innovation?
Yeah, so I think that the first thing to recognize is that Singapore has world-class research on its own. The fact that there has been a number of Singaporeans actually going outside of Singapore, studying, and then coming back into Singapore, into A-Star, and to other institutes to then research and found their own startup in biotech is actually something that has put Singapore on the map in terms of the biotech ecosystem globally. Now, that in turn has, of course, attracted the attention of large pharma, which have placed into Singapore both manufacturing and investing hubs, as well as global capital and global VC, as you were mentioning, Flagship Pioneering, but is only one of the many firms that are actually setting up in Singapore. That is effectively allowing Singapore to play what I would say is an outsized role in global biotech. It has become a launchpad for a lot of the pharma companies and a lot of the biotech companies globally. And ultimately, this will allow Singapore to actually be one of the places where new drugs are discovered and new drugs are sold globally to pharma companies that then will in turn use that as their sales and marketing, as the drugs that they will globally distribute in sales and marketing.
Then in what ways does Singapore's regulatory and innovation environment provide resilience against, global biotech market shocks?
Again, I think that Singapore has the advantage of, number one, strong IP protection, which allows for pharma companies to defend the IP that they've gained in, anywhere between 5 and 7 years of development for a new drug, as well actually as the talent to continue research and developing that drug through the clinical phases that the drug needs to be developed. As I mentioned before, every drug needs to have a global market in order to recoup the cost of investments that sometimes can run into the billions of dollars, $1 to $2 billion for each drug that is actually being launched globally. And so that stability that Singapore provides is quite important for investors because they will need to recoup that investment over the life of the patent of the drug that runs anywhere between 15 and 20 years.
I see. Then, regulatory agility and policy environments that protect IP are increasingly factored into investment decisions as well. So, Fabio, how do these factors influence investor confidence and the speed of innovation in APAC biotech markets?
I think the speed of innovation is mostly actually dictated by clinical trials. One of the interesting things that is happening in Asia Pacific and especially in China is actually the fact that you can run clinical trials much faster than and at a cheaper cost than other developed markets. And so actually Singapore, what you're seeing in Singapore is a lot of the Singaporean companies are creating hubs in Hong Kong and in Shanghai in order to take advantage of that faster clinical development. Just stepping back for a second, the typical drug will spend anywhere between 7 and 10 years being tried in humans from phase 1 to phase 3. That timeline is being significantly cut in China because of two reasons. Number one, the ready availability of patients. And number two, the fact that these patients have not been subject to treatment before. And so it's easier to find the type of patients that you need for a clinical trial in such an environment. What that is doing is effectively speeding up the global development timelines for a lot of companies, as well as doing this more cheaply than we said. So if the cost of a drug was $1 billion before, it can be cut significantly down because of the speed at which clinical trials are being, and the fact that Singapore can act as a launch pad for these new companies doing clinical trials in China benefits Singapore as well because the IP rights and therefore the royalties and other payments that get made on those drugs will eventually fall back into the Singapore market.
Well, after all, APAC is emerging as a frontier for next-generation biotech, including AI-driven drug discovery, gene therapies, and antibody drug conjugates. So what types of biotech innovations are likely to drive the next wave of investment in the region, Fabio?
I think it's actually exactly what you mentioned, which is ADCs or antibody drug conjugate is one of the biggest pool of investments right now in Singapore and beyond. In fact, one of the Singapore companies, Hummingbird Biotech, actually was funded for about $185 million to set up a new company called Kallio Therapeutics just to fund a number of ADC programs. You will see that in China as well, where a lot of the ADC companies are getting funding. The other area where I think there will be a revival of funding is actually cell and gene therapy. Cell and gene therapy has been a difficult spot for investors over the last couple of years, primarily because of the fact that a lot of these therapies were not being reimbursed in the developed markets, so US and European Union. But what you're seeing now is a revival of M&A desire from large companies buying these new therapeutics. And therefore, what will happen is also venture capital will start funding these therapeutics again. Hopefully, what we will see is the reimbursed markets, so again, US, European Union, to a certain extent, Singapore, and others, start reimbursing these therapies more readily and therefore reigniting investor appetite for these drugs.
So for investors entering APAC biotech now, what strategic considerations should guide their portfolio decisions?
I think partly it has to do with, again, IP protection and where some of these biotechs can be located and can be found. So Singapore, South Korea, Japan offer such an environment. The other consideration is, of course, scientific, where in China specifically, there is a lot of new drugs, new what we call first-in-class, which means effectively they're targeting new biological pathways that are bound to be the new drugs of the future. And that position of first in class is typically something that comes with significant investment returns. And so again, the scientific side of discovering biotech needs to be taken into account when thinking about investing decisions.
Right. Well, some great insights from you there. Thank you so much, Fabio, for joining me today.
Thank you, Hongbin. It was a pleasure.
Thank you. That was Fabio La Mola, partner at Bain Company. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.